and welcome again, everyone. Session number 7. It's hard to believe we're here out of 7. We've already completed, and we only have 3 left to go. So I thank you for being here. It's been a fast month, and I appreciate you being here. And if you remember, Richard was here to kick our series program off. And if you remember, he loves questions, so please ask the questions today. And Richard does come to us, his business, FranNet, and he'll tell you a little bit more about that. And he certainly is a wealth of information, so I always feel very fortunate when he's here to share that information and his expertise with you. So, Richard, thank you for being here. And I know today's topic is a big one for everyone, so we appreciate you sharing everything that you do with us.
Well, thank you, Diane, and thank you also for asking everybody to ask those questions, because if you're on the first session and you know that I'm going to keep nagging you about getting questions, I think it's important for everybody if you ask questions, because I can't possibly anticipate everything that you might want to know. So it helps everybody if you add in your questions. Today, our topic is funding. This is, whether it's in my own business, in my own world, or working with Diane, this is always, I think, the most popular thing, and for obvious reasons. It's certainly one of the big obstacles that people face when they're thinking about starting their business, and it doesn't have to be. It's actually can be easier than a lot of people think. So that is our topic for today. Very quickly, just so that you know, I came to small business ownership the way most people do. It's a second career for me. I spent 25 years in the corporate world, and about 30 years ago, so I've been in business for a long time. About 30 years ago, I shifted over into small business ownership the way most people do. It just was a second career for me. I saw people do very well, not just in my particular world, but in small business ownership in general. I saw people do really well. I also saw people fail. And what I believe and what I learned over those years is that the people who fail didn't take the time to invest in learning. And this program that the SBDC and Diana are putting on is really a tremendous help to those of you who want to start your own business and do it safely. So I got into this world trying to help people be successful. I know owning your own business can be a much better life. So with that said, I will also tell you that it is from the perspective of a consultant who helps people get a business off the ground and someone who has started businesses and done funding that I come to you today. So I am not an accountant. I am not a financial advisor. I am not a lender. And at the end of the day, I encourage you to talk to all of those kinds of people beyond me. But I think the value that I can bring to you is looking at it closer to your perspective. I know the funding aspect of the business by helping my clients get funding. So while I'm not a financial person, I think I can share with you a lot of information about how to find funding options. Second thing I would ask you to keep in mind is that one of the options you're not going to hear me talk too much about is using your own cash. If you are a responsible individual and you have spent your life managing debt and making sure that, if you needed something and you couldn't pay cash, you waited until you could do that. That's a very responsible way to live your personal life, and I applaud you for that, but that's not a good way to start a business. Use somebody else's money to start your business and protect your cash. And I think most financial advisors would recommend the same thing. There are some other options, I guess, that we're not going to cover today, but there aren't many. We're going to cover the most popular things that people do. And then finally, I would tell you that if you're looking for me to tell you what the best solution for funding your business is, I can't do that. All funding is going to be very personal. It's going to be your circumstances, your business, your financial status. I mean, there are a lot of things that go into picking which option is going to be best for you. So I can't tell you which, sitting here today, talking to an audience of maybe 20 people, I can't tell you what's best for you. It is a personal decision. So try to use this as a way to try to start thinking about, where do I feel most comfortable? Where do I think I would be most successful in getting funding? So with that as background and an introduction, let's get into the most common way that people fund their business startup. And it is through an SBA, a Small Business Administration loan. Banks do offer more conventional kinds of loans. I will tell you that it is almost never going to happen that a bank is going to give you a traditional, conventional business loan outside of the SBA support. They just don't want to take the risk on startup businesses, which do have, frankly, a higher failure rate. So what you're most likely going to be looking at is an SBA loan, and SBA loans don't come from the SBA. They come from lenders. They come from banks. Your local bank, it may be an SBA lender, and the bank is going to process that loan. And the SBA, if they accept it, is going to guarantee the loan to the bank, not to you. So if, God forbid, your business should fail, the bank is still going to chase you and your assets to get their money back. But if that fails and they can't get the money back from you, then the SBA is going to step in and guarantee something like 65 or 75% of the principal on your loan. So it's not a guarantee to you, it's a guarantee to the bank. And what that does is it encourages banks to take a little bit more risk with startup businesses than they might otherwise do. So this is the most common way that people get money for a business startup and also for franchises. The purpose of the SBA, it's the Small Business Administration, and the SBA is backing these loans with the interest in getting loans out there for less than $150,000. So they are looking primarily to do small loans. However, there is a maximum loan value of $5 million. So they can get pretty big, but the goal, the purpose of SBA loans is for those smaller loans. To get an SBA loan, you're going to need a strong personal credit. You need to be creditworthy. One of the big factors is going to be a credit score. I would tell you if your credit score is lower than 675, and that number will vary from bank to bank, business to business, person to person. But generally speaking, I would say your cutoff is 675. If your credit score is below 675, you probably are going to have a hard time getting an SBA loan. The other thing that really trumps everything else is post-closing liquidity. And we'll talk a little bit more about that later, but the bottom line is, do you have access to money to back your business up in case of an emergency and to cover your expenses during the startup period when, frankly, you're not going to make money? I tell my clients, even in the franchise world, I tell my clients that you should assume, without being business specific, it does vary by industry, but general rule, you start up a business, you're not going to make money for a year. And you need to understand how you're going to cover expenses, how you're going to cover emergencies, how you're going to keep a roof over your head. So a bank is going to want to know what your post-closing liquidity is. So after you've paid all your fees to the banks and you've used up the cash that you're going to have to contribute, how much money do you have access to after that? That trumps everything. Personal guarantees. Of course, you're going to, as you start your business up, you're going to want to incorporate. And well, I'm sure understand that the purpose for incorporation is to protect your personal assets. You don't want somebody falling on the ice in front of your business and suing you and taking away your house. The only thing someone who falls on the ice in front of your business can sue you for is things that are owned by the business. So, of course, when you're in a corporation, that's your purpose, is to protect your personal assets. However, banks and landlords, by the way, will almost never let you go without a personal guarantee, at least to get started. They might release that at some point in the future, but at least to get started, you're going to personally guarantee the loan. Typically, historically, banks will be looking, and this is where your personal cash comes into play. They are going to be looking for you to put some skin in the game, as they say. So if your project is $100,000 project and you're looking to fund that amount, the bank is going to say to you, okay, to do that, you're going to need to put $20,000 to $30,000 of your cash in, and we will lend you $70,000 to $80,000. If you buy somebody else's business, so if you're buying an existing business or if you're doing a franchise, that number usually comes down to 10 to 20%. Most of my clients are looking at 10%. Again, it's an issue of safety for the bank. Banks feel safer if you're buying an existing profitable business or if you're buying a franchise, banks feel safer about that. So they reduce the amount of cash you have to put in. If you're starting on your own from scratch, assume that you're going to need 20 to 30% cash in. You may need to provide collateral. If the loan that you're looking for is under 50,000, you will not need collateral. If the loan you're looking for is above 350,000, you will need collateral. And if it's in between those, it's up to the bank. The bank can ask you for collateral if they want to. And that's going to depend on how much risk they think they're taking on. So collateral is going to be something that the bank can liquidate. Could be your house. That's the most common thing they look for is real estate. Could be the inventory of the business, if that inventory could easily be sold. Could be equipment. Vehicles are an easy form of collateral. But the point here, collateral is if you can't pay the loan back, what can the bank take away from you? Keeping in mind that you're going to sign a personal guarantee. What can the bank take back that they can liquidate and get their money back? So again, even though the SBA is backing the loan, the bank first has to try to get the money from you. You will also need, particularly if you're starting from scratch on your own, the bank is going to want to see your resume. They're going to want to see that you have the experience, the knowledge, the capability to make this business be successful. And they want to see your plan to make that happen in written form. So you will need a business plan. I believe, I'm almost certain that one of the classes in this series is on writing a business plan. SBDC coaches, counselors are excellent sources of help for getting a business plan done. But you will need a comprehensive business plan. And you should know that some businesses are not eligible for SBA loans. They don't do liquor stores. They don't do businesses that sell tobacco. They don't. There are some other oddball businesses where if the receivables come in through a third party, then they won't do an SBA loan for that type of thing. Most businesses are going to be acceptable to the SBA, but there are some exceptions. With the new administration coming in and with COVID assistance and incentives to keep the economy going kind of in the rearview mirror, in 2025, there were some policy changes that have made it a little bit tougher, but it's really bringing it back to where it was in the past. The banks will charge you a fee, a closing fee. One of the closing fees will be 3 to 3.75% of the loan value, which is a loan guarantee fee for the SBA. If your loan is 50,000, I already said you don't need collateral. You have to have it over 350. Working capital, this is the issue about having liquidity, having the ability to acquire, to raise cash if you need it. Very often that's done in the form of a line of credit. Or you can put it into your SBA loan, but if you're putting it in, then you're going to need to provide a very specific explanation about what you're going to use that working capital for. They are looking much more closely at business plans today. So again, I would encourage you to get support in putting your business plan together. Certainly an important part of your business plan is going to be financial projections, which need to show several years out and how quickly you're going to become profitable. And there needs to be a rationale behind why you believe you're going to become profitable that quickly. The business must be owned by a U.S. based individual or corporation. Foreign entities cannot get SBA loans. And again, back to collateral, if the bank decides they want to use collateral, they can use anything that they choose to. So that's the background for an SBA loan. And I don't see Diane jumping in with any questions, so I'm guessing there haven't been any. But please, if I'm going through this too fast or it's not clear, interrupt and put your question in the Q&A. So what about interest rates? That, of course, is an important factor in all of this. And interest rates are, as you know, interest rates are high these days. There's a formula for calculating to give the banks parameters for what your interest rate is going to be. Sometimes it seems odd to people that the smaller the loan, the higher the interest rate. So if your loan is 50,000 or less, the bank is allowed by the SBA to charge you prime plus 6.5. If your loan is above 350,000, it's prime plus 3%. Now that 6.5 or 3% is the cap. They can charge less than that. So let me give you an example. As of right now, the prime rate is 7.25. If we took a $200,000 SBA loan, the maximum rate that the bank could charge you would be 6% for that variable factor, and plus the 7.25, which means that your bank loan could be as high as 13.25 for a $200,000 loan. Now that's the maximum. The bank could choose to charge you as little as 0 and charge you only 7.25. Not going to happen, but they could do that. And that is going to depend on who you are, how comfortable they feel with you, how comfortable they feel about your business plan, your credit score. Again, going back to that liquidity issue, that's really key. I'm seeing most SBA loans for my clients, almost regardless of the loan amount. I'm seeing most loans coming in at 9% or maybe a little bit lower. So right now they are on the high side. So that is how they are calculated. And I'm guessing there's no questions on that. So please jump in. So that's what I would tell you about SBA. Again, for people starting a business up from scratch, this is the most common way they're going to do it. Let's talk about some other options then. So one other option that I'm going to guess that you are not, we've got a question.
Yes, you do. Thank you. If I have good credit, what could be a reason I'm denied?
If you want to open up a bar, you're going to get denied. First of all, SBA won't do a bar. And second of all, bars have a very high failure rate. So if a bank looks at you and says, you know what, you're a great person, business person, you're a person of good character, you are financially sound, your credit score is good, and your liquidity is good, and we like you, but we're not doing a bar. If they think that your business is risky, they're not going to fund it. Again, not to beat it to death. If you've got a great credit score and a great business concept, but they're wondering how you're going to get through the startup period because you've got no money to fall back on for emergencies or operating capital, they're likely to turn you down for that. So the bank is going to judge your business plan and how you say you're going to become successful. And if it doesn't make sense to them, doesn't matter how good your credit is, they're not going to lend you money. They've got to believe in your concept. Thank you. That was a great question. All right. So let's look at some other options. That's the most obvious option, some other things. And let me make your head hurt by suggesting that maybe you want to think about using retirement funds to get your business started. Really? It doesn't sound on the face of it like a very good idea, because if you take a distribution from your 401k or IRAs, you're going to pay a significant amount of tax and a significant amount of penalty. The penalty is going to be 10%. Tax, let's say, is going to be 30%, could be more. So if you take out a $200,000 distribution, and again, I'm just using round numbers here, it makes it easy for me to do the calculations. You're going to give up 10% off the top for a penalty, and you're going to pay taxes that so far you haven't paid on that money. So state and federal taxes are going to be paid. So you could wind up taking $200,000 out of your account and only getting $120,000 for your business. So that doesn't make a whole lot of sense. And I would really discourage anybody who's thinking about doing that. But there is a way that is not, there's not a lot of knowledge about this, although it has been around for almost, I think it's actually 40 years that people have been doing this. And that is what's called a rollover for business startup. That's what the IRS calls it. Unfortunately, that comes out to the acronym of ROBS. So I wish they would change that, but it is called a rollover for a business startup. It is one of the less common known ways of funding a new business. The idea here is just quick introduction to the idea. If you change jobs and you're like most people, if you have a 401k plan or a 403b or a TSP or any of those pre-tax retirement plans, you're probably going to roll it over into your new employer's plan. So the first idea here that I would like you to think about is if you had your own business and you incorporate properly, it has to be a C Corp, and you create a 401k plan for your business, and you can do a rollover and roll the money into your company's plan, and your employees can join that plan and they can roll money into it and they can make savings and contributions, and you can invest in all the same things that you're investing in with your current employers. So that's the starting point. All you're doing at the beginning of this idea is creating a 401k plan for your new corporation. This allows you to avoid that 9% SBA interest rate. This option is fully approved by the IRS. It's been in the IRS code for 40 years. We talked about that you're going to need a cash contribution, and the bank wants to see that you have liquidity. This could be a way to address those issues. This works for any pre-tax retirement plan. So again, TSP, 403b, whatever, but it does not work for a Roth IRA. And the funds cannot be rolled from your current employer. So if you're going to keep your job while you start the business and all of your 401k money is with your current employer, you can't roll it out. And it has nothing to do with this plan. It has to do with the fact that your employer won't let you roll it out. This option, which I'm going to explain in a little bit more detail, with this option in the franchise world, more people use this than they do SBA or any other way of funding businesses. It does, however, require expertise. It does require that you have a plan administrator who is going to run this plan for you, set it up. There are some restrictions, as I already said. You need to be a C Corp. So what would a plan administrator do? The plan administrator would create your IRS compliant C corporation to allow you to have a 401k. They would design a plan for you and your business and your employees so that everybody can participate. They would then work with whoever is holding your money now to your previous employer or your stockbroker or whoever's holding the money. Will arrange for the rollover into your new plan. That then generates revenue or money that goes into your company's bank account, not yours. So you're not getting the money. Your corporation is getting the money, and your corporation can use the money for anything it wants to use it for. No taxes, no penalties, because you're not getting the money. Note that I said that transfer is going to be into your corporation's account, not to your personal account. If you touch the money, you're going to have to pay taxes and penalties, but you're not going to touch it. It's going to go into your company's plan and a bank account, and you can use that money for anything else. It's just like what General Motors would do if you bought stock in General Motors through your 401k plan. You're not General Motors, you're ABC Enterprises, and ABC Enterprises can use that money for anything they want. Now, this one usually generates some questions, so feel free to jump in, but let me give you some ideas about what this could do. So first, you're investing your retirement money in your company. You're not spending the money. So that's one of the fallacies. People think that, oh, I'm spending my retirement money. No, you're not. Instead of investing it in Fidelity funds, you're investing it in your corporation. It's an investment strategy. And because you're not taking the money out in a distribution, no taxes and penalties. It eliminates interest and debt. You don't have to pay that money back. and it's not a loan. So there's no interest, there's no debt to be paid back, which is going to make the startup of your business a lot easier. Remember, as you said before, you have to assume you're not going to make much money in the beginning. What we've just eliminated is a monthly SBA loan payment. This has been around, as I say, for 40 years, perfectly legal. It's in the IRS code. If you do an SBA loan, it's going to take at least 6 weeks, probably 2 months or longer to actually get the loan approved and have the money put in your account. This, depending on whoever is holding the money today, can usually be done in 2, maximum 3 weeks. You've got the money in your account. So you're using pre-tax dollars. So you've never paid taxes on this money. So, anything you take out of your cash, you pay taxes on that money. So this is using pre-tax money. You can use this as a cash injection. So that 20 to 30% we talked about earlier, that can be where that money comes from. It puts equity in your business right away because you've got all this cash infusion into your business, and it lets you optimize the equity and the value of your business. The other thing that I didn't touch was this one. During that period of time when you're not making much or any money, one of the things that you can do with this, your company can do what it wants to do. Your new corporation can do whatever it wants to do with that money. And so if you need a salary to get yourself through that first year, the business isn't generating the money, you can use this as a way to pay yourself a salary or your employees a salary or buy inventory or pay for construction or pay for advertising or do anything that you want. So I am a little surprised that didn't generate a question, but we'll keep.
Yes, we do have one here for you, Richard. How much of an impact does the name of your business have on getting funded?
Well, I could be vulgar here and come up with some names that a bank wouldn't really like you to name your company. As I said earlier, a bank does look at your character and does look at other things besides financial considerations. So they look at your credit score, they look at your liquidity. They will tell you, we also look at character. Now, if you come up with a name that's going to scare them and make them think that your business is going to suffer because you've come up with a really bizarre name that's going to make people not want to do business with you, that's not going to work. Other than that, I mean, it has to be a name that's not being used by some other corporation. But other than that, it can't be somebody else's name. And the bank has to feel that it's going to help your business. But other than that, there's no restriction on the name of the business. All right. So I don't want to beat the idea of rollover to death, but there are 2 more aspects of this that I would want to touch on. One of the things that I see a lot of my clients do is do both a rollover and an SBA loan. First, the rollover will make it a lot easier to get the SBA loan because the bank is looking at somebody who now has significant cash on hand. And the bank is saying, yes, we can see why this is a $200,000 investment. Oh, but you're only asking us to put in 100,000 or 50,000 or 125,000, some amount that's not the full amount of the business startup. The more money that you're willing to put into your business, and they don't care that it's coming from the rollover, the more confident the bank is that this is going to be successful. So it makes it a lot easier to get an SBA loan if you do it in conjunction with a rollover. Again, a lot of my clients will do a portion SBA and a portion from a rollover. And then finally on 401ks, there are participant loans. If you've got a 401k or one of those other plans, you probably understand that you can borrow money from yourself. You can borrow up to $50,000 and or up to 50% of the vested amount in your account. So if you've got 100,000 in your 401k, you could borrow up to 50,000. So you can get half of what's in your account as a loan. You're going to pay that loan back to yourself. So you could perhaps slow down your contributions for a while, and the amount that you were contributing in the past, you're now going to use as a loan payment back into your account. Is there interest? Yes, there is interest, but it's going to be much lower than the market rate. And the interest is going back into your account. So if you're looking for a smaller amount, again, this could be that cash infusion that you need for an SBA loan and you don't want to do a rollover or can't do a rollover, but you needed that little extra cash for your cash contribution. This could be a way to accomplish that. Could also be a way to do your salary. Again, smaller amounts, but very viable. Yes, Dan.
We have several questions for you right now.
Um,
Yeah, I know you love these. If rollovers are used to start your company and you spend all of the money on equipment, then what happens if the money is not made back?
Well, again, it is not a loan, so there's no obligation to pay that money back. But the only time you're going to feel that is if you sell your business and your business has failed and you only get back half of what you initially put in. Well, then when you sell your business, you're essentially buying that stock back at half the value. It's just if the stock market collapses and you lose your investment there. So you can use it for purchasing equipment and it makes no difference. There is no debt service here. If I'm not being clear or if I'm not answering your question, please follow up.
Okay, thank you. Next question. How does the retirement funding work as far as once the money is rolled over? How do you have access to the funds for use without penalties?
So when they take that rollover, you're in essence, it's not exactly the way it works. In essence, you're buying stock in your company. So what you're getting is stock, and what your company is getting is cash, and that cash is going into your company's checking account, and you're going to write checks and take out cash, and you're going to do the same thing that you would do if you got an SBA loan. The SBA loan is going to go into your bank. The money is going to go into your bank account, and you're going to spend it on anything you want. Same thing happens here, but again, it is not money that's coming to you. So no taxes, no penalties.
Okay, and Amanda, I think that answers your second question as well. If not, let me know there. Next question. How about double taxation? Is there a way out of such a monster?
Well, we could talk about double taxation on one of the next options coming up, but here there's no taxation at all. The only time you're going to pay taxes is if, as again, you bought General Motors through your current plan, you take out that money, you're going to pay taxes on it. If you buy stock in your company and you take it out, you're going to have to take a distribution. You're going to pay taxes, but there's no double taxation. You never paid taxes on this money to begin with, and you're only going to pay taxes if you cash it out of the business.
Okay, thank you. And I think when you retire, if the money has been spent, referring back to her last question, Keisha's last question, which was if rollovers are used to start your company and spend all the money on equipment, what happens then? And I think
Again, now this is assuming, which is the same thing that you assume when you're buying stock in General Motors, that General Motors is going to be successful and be able to give you not only your original investment back, but also equity growth. That's what you assume is going to happen when you invest money in General Motors. If you invest money in your company, and let's say, again, you're just using numbers, you had $200,000 that you initially invested in your business, and now it's time to retire. It's 10 years later. Your business has been successful. You're not going to sell your business for $200,000. You're going to have equity growth. It's now established. It's profitable. It has a customer base. It has employees. It's worth more than what you originally invested. So when you sell your business, the equity growth, so you sell originally it was $200,000 to start, you sell it for $500,000, that equity growth is $300,000. You never spent the money. This again is the thing that people get confused with. When you do this, you're not spending your retirement money. You're investing your retirement money in a company that you just happen to own. And that company, if it's successful, and there is that if, for this to work, your business has to be successful. Your investment in General Motors has to be successful. So it's the same Everything is exactly the same. I'll try to keep that analogy. You're not spending money, you're investing money.
Okay, thank you. Can I continue to contribute to my rollover 401k from my salary?
You absolutely can. And moreover, you could put more money into your company, or you could tell us. So let's again, I keep using 200,000, just easy numbers. Let's say you had $200,000 in your rollover, and your business really only needed 100,000. You're going to tell the plan administrator, okay, I want to buy $100,000 of stock in my business, and I want to invest the other 100,000 in Fidelity and General Motors and whatever you want to invest your money in. And every year you can make a contribution just like you do now. So yes, you're going to have a plan administrator. This is going to look exactly like your current company's plan. You can do all the same things that you're doing in that plan. And so can your employees, which by the way, is going to make you a much more attractive employer. Not many small businesses offer a 401k plan. This benefits you. It also makes you an attractive employer. Thank you for those great questions. All right. So let's leave retirement monies behind us. But again, if you got more questions, keep going. Another option, which is an interesting one, is a stock portfolio loan. And here we're talking about investments that you've made that are non-qualified. They are not retirement investments. It's just your normal stock investment. So that non-qualified. And what you're essentially going to do here is you're going to use your stock portfolio as collateral for a loan. Many stockbrokers, investment firms, will lend you money against your account. You can also find some banks which will lend you money using the collateral in your stock portfolio as collateral. Now, as it would be the case if you were using your house as collateral in a loan, you're not going to be able to use the full value of the money. So if you had $100,000 in your stock portfolio and you're looking to collateralize, they're only going to give you credit towards that collateral of 60 to 80% of your stock portfolio because they have to allow for fluctuations in the market. So the collateral has to cover your loan, and they're not going to say that 100% is secure. So I hope you understand what I'm saying there. When you do this, you're going to get the benefit of, particularly if you're working through your stockbroker, is that loan is going to be processed faster. And you're avoiding the tax ramifications of, in other words, if you said, well, okay, I need to put cash in, and so I'm going to take $50,000 out of my stock portfolio. I'm going to cash in $50,000 worth of stock. You're going to pay capital gain taxes on some portion of that money. And in this case, you're not taking the money out of your account. You're using the money as collateral against your loan. So the money stays in your account and you continue to earn money in the stock market. So you're not paying taxes and you keep the appreciation and the dividends from your stock portfolio. Very often I'll see people use this as a way to get that SBA cash injection. So again, here, you're not cashing out of your stock portfolio. You're borrowing money against it. Yes, you're going to pay interest, but the stock portfolio is also making money. So it's offsetting some of that interest, if not all of it. Now, the one caution I would give you here is that if you are an active trader, if you're somebody who is, buying and selling frequently, this might make you uncomfortable because you're going to have, every time you want to make a trade, the lender is going to have to approve that trade because they're using your money as collateral. So if all of a sudden you want to go into something that's very high risk and they gave you 80% of your portfolio value to begin with, they may now say, well, wait a minute, this is only going to be 25% because it's so high risk. So it could slow down or impact your flexibility in trading. That I would say is probably the only downside on doing this. So that's another option a lot of people don't think about. One on the face of it gets a little bit spooky, but you got to think it through, is using the equity in your home. And you can do that in one of three ways. You can get a second mortgage, gives you a lump sum payout and probably a fixed term. And you've done that using some of the equity in your house. You could do a HELOC. The HELOC can be used for any purpose. It can also be used as your liquidity. It can be used as the source of cash if you need it. Again, it's a line of credit, so you're not taking the money out unless you need it. Think about the HELOCs right now are approximately 6%, I think maybe a little bit over in most cases. So we could do a 9% SBA loan, or we could do a 6% HELOC, or we could do a refi on your first mortgage, completely refinance your whole house, take some of the equity out, and your mortgage is a new mortgage is probably going to be around 6.8. So again, 9% to the SBA, 6% to a mortgage company. Pretty hard to justify why you should pay 3 points more for a loan. And the complication here is that if the bank wants to use your house as collateral or is using it to see that, again, it doesn't have to be collateral that we assign, but they're looking to see if we loan this person money and they fail, I want to be able to get my money back and I could attach their house. Even if you haven't identified it as collateral, they can still do that. But they're only going to do that for the equity that they see in your house. You're using up that equity. So this does affect how much money you're going to be able to get from the SBA. Not always a good strategy if you're using it to complement the SBA loan, but to use it as a separate way to raise the money, you're saving quite a few points, at least in today's lending environment. No questions on that. Another thing that you should be aware of, and here again, I would refer you to your SBDC counselor, consultant. There is, from time to time, money available, usually at the county level, sometimes state funded through the economic development offices. There are loans that you can obtain for a business startup. Sometimes these loans are targeted to underserved groups, women, minorities. Sometimes they're targeted by geography or industry where the county is looking to revitalize a certain area or to bring in technology workers. So sometimes they'll target it for geography or industry. Usually the interest rates are below market. And usually the economic development offices are going to be a little less risk averse than a bank might be. They are almost always going to be limited in the amount that you can borrow. And the county also, particularly if it's state funded money, the county's going to get a bucket of money. And once they use that money up for the year, then they've got to wait until next year when they get their new bucket of money. So how many loans they can actually get done will also vary in any given year. Best source to learn about this really is your SBDC mentor. And you can also talk to your SBDC mentor about grants. As I've said, I've been helping people get businesses started for over 13 years. And very common question is, what grants are available? Who is going to give me money? That's what a grant is, right? I'm going to give you money. Where can I find a grant to start up my business? It's a very common thing for people to ask about, and it doesn't exist. For all purposes and intents, there are no grants to start up a business. You will hear from time to time, economic development has got grants available for. Those are almost always for existing businesses and targeted specific things inside of those existing businesses. So if there is a Main Street project, right, the town is looking to upgrade their Main Street and they'll give out grants for improvements to facades on the buildings. I see that from time to time. I see from time to time workforce development money that you can get that you can then use to pay for training and workforce development. So you will see when you hear grants, you're going to probably hear that they're always for existing businesses, not for starting up a business. I wish I could tell you otherwise, but that is in fact the case. But the loans are available, and there are some advantages to those. All right. Some questions on that? All right. Our last option has a lot of different components to it, and that is partnerships. Again, something I hear very frequently for somebody who maybe doesn't have the financial resources on their own to get a business started. They are thinking about, well, maybe somebody will help me out. And that could be helping me out by becoming a partner, an actual business partner with an operational role in the business. I and my best friend are going to start this business up together, and we're going to pool our resources to qualify for the funding that we need. The second option is a passive partner with ownership rights. I'm really an investor. I've got a client right now who has got a passive partner, someone who has quite a bit of capital and is willing to make an investment in my client. And we're not going to do an SBA loan. This person is going to have a promissory note and ownership rights to the business, but not be involved day to day with the business. So they're just an investor. Could be passive, non-owner, co-signer. I don't want to have the liability. I don't want to be involved in day-to-day activities, but I'm willing to co-sign a loan. So you by yourself might not qualify for the loan, but I will come in and I'll co-sign that loan. And with my collateral, with my liquidity, we can get you a loan if I co-sign the loan. I don't own the business. I don't have an interest in the business. I've just co-signed your loan. Sometimes there's a gift. I see this from parents and other family members with some frequency. I'll help you out. I will give you X money. That happens from time to time, usually smaller amounts, but still could be that cash infusion that you need to get the SBA loan. And then finally, kind of along the same lines as what I hear about grants, I hear a lot of people talk about angel investors, venture capital. Some other almost anonymous person is going to come and through the internet is going to invest in your business, or a venture capitalist will do that. There's a belief that this is something that's very viable. I can't say that it doesn't happen, but you don't have to take my word for it. Go on the internet and search how many businesses are funded by angel investors or venture capital in the United States, and you're going to see that it's maybe 1% or less, but not much above 1% of all business startups are done with angel investors and venture capital. Can you pursue it? Of course. Is it likely that you're going to get it? Probably not. And very difficult to put together a business plan and start moving forward on these, because usually the angel investors and venture capitalists want to see a complete plan. So you want the plan, but you don't know if you're going to get the money. So it's kind of a chicken and the egg thing. If you have a way to fund your business, but you would like to explore this as well, great idea. Go ahead and do that. But if you think that's how you get all the money, probably not. So those are, I think, the most typical way that you'll see partnerships play out. Some things to think about. I'm going to talk about risks and obligations here. I don't mean to discourage anyone from thinking about a partnership as a way to raise the money. It's not a bad way at all, but you do need to understand some things, because all too often, especially when it's friends or family, it gets a little informal. And that's where I would caution you. So I would caution first that particularly if you're going to have an active partner, that you be very clear about roles and decision-making and exit planning and income distributions, and that all of that and much more be formalized in an operating agreement. That operating agreement be drawn up by an attorney who is going to know all the considerations. So let me give you an example. You and a partner, and you want to take the corporate money, the money that the company made after you both took a salary, and now there's money that the business has made, and you would like to invest that in an expansion, and your partner would like to take it as a distribution. Who decides? We've got advertising that we want to do. And I would like to do it on TV, which is very expensive. And you would like to do it in digital marketing, which is very inexpensive. Who decides? And a real good example is we're 5 years in. I'm tired of this. I don't want to do it anymore. But boy, we've been really successful. So I want out and I want my equity growth. I want you to pay me to get out. Who decides how much equity growth there is? What if you can't raise the money to buy your partner out? There needs to be exit planning strategies and agreements that are formalized. We have a question.
Yes, thank you. Are you familiar with organizations that offer microloans as an alternative? For example, Maryland Capital Enterprise. Do these organizations have similar requirements as SBA to secure or guarantee a small business loan?
Yeah, thank you for that. Sometimes those lenders exist under the umbrella of something else. Maryland Capital Enterprises is in fact state money. It's economic development money for the most part. And yes, those are out there. As I said at the beginning, I'm not covering every opportunity there is. On the Eastern Shore, there is a corporation that's been set up for that kind of micro loan. So yes, those do exist. And they're more like what I said about economic development than they are like SBA.
Okay, thank you. Is Maryland Department of Commerce still a viable option for those that may have trouble securing normal bank loans?
Again, it falls into that same economic development bucket. Yes, it is. They are likely to take more risk than a bank would, even a bank with the SBA loan. Again, they are also very eager to help underserved, or some organizations are looking for underserved populations. Historically, women and minorities have had trouble finding funding for a variety of reasons. And so a lot of that money gets targeted for women and minorities. So yes, that is viable. Most government money does come through the county, but in any case, your SBDC counselor is going to be your best source for finding out what money is out there. Thank you for the questions. All right. So having an operating agreement to cover all of the things that could create strife and disagreement and failure inside of a business because we didn't have an understanding going in. There are some real risks that come along with this. So make sure that if there are loans and leases involved in these partnership arrangements or any other kind of contractual agreement, that you understand the obligations and provisions of those agreements. One in particular thing that I caution people about is the phrase that a lot of people see but don't really understand, and that phrase is joint and severable. And what that means is if there is more than one person who's taken on an obligation, that the bank or your landlord, and sometimes other contractual agreements will have this phrase in it. And what it means is that the creditor can decide if things go badly and you and your partner are no longer able to keep the business going and the bank is in jeopardy of losing the principal on the loan, the bank can decide to chase both of you equally for the money, or the bank can say, you know what? You have assets that would be a lot easier for us to go after than your partner does. Your partner doesn't have any money, doesn't have a house. We can't get our money back from him. So we're just going to go after you to get that money back. A landlord can choose to chase, if the business folds and you've got a 5-year lease with 3 years left on it, the landlord can decide who they want to chase for the money. They could chase both of you, joint, or they can break one of you out and ask only one of you to pay the money back, severable. So there are some things you need to make sure that you've gotten legal advice on and you understand all the provisions of contractual agreements as it affects partners. Yes, Dan.
What is your opinion on financial tech companies as a business funding option?
Perfectly fine as long as you check them out and you know that they're reliable. So you want to make sure that you don't want to take loans out from people with exceptionally high interest rates and who have unusual ways of getting their money back if you don't pay. So yeah, you want to avoid the loan shark. But yes, there are institutional lenders who don't have a bank on your street corner, but do SBA loans. And there are a number of them which will take on high risk loans. So where a bank may say, no, this is too risky for us, we're not interested. Some high risk lenders will take those kinds of projects on. Of course, you're probably going to have higher closing fees. You're probably going to have a higher interest rate. So it's going to cost you more to get that money. But yes, that is a viable option. Particularly with the more passive partners or the gift giver. Oh, yeah, I just love you to death and I want to see you succeed. So I'm going to give you this money and go out there and be successful. And now 6 months into it, I want to see what you've been doing with my money. Well, wait a minute. That wasn't part of the deal. You weren't going to get involved in me and helping me make decisions. Well, wait, what do you mean? I mean, I lent you all this money. Certainly you want to be telling me what's going on. Is that the passive partner that you want? So make sure that you understand what the relationships are. And where it comes to gifts, there are tax laws on gift giving. There's only a certain amount of money that you can give to somebody before taxes become an issue. So make sure you check with your accountant on any gifts. And that brings me to the last point on risks and obligations. And it really is, in so many aspects of business ownership, it is important. I know it's expensive and I know you don't always like doing it, but engage with an attorney to document all of these kinds of operating agreements and to make sure before you sign a lease, have an attorney look at it. You never know what's going to be in there. So be careful with legal documents and contracts and promissory notes to make sure that you understand what's going on and seek out expert advice. So those are the options that I wanted to cover. And just to summarize, which one of those should you pick? I don't know. Depends on you, depends on your circumstances, depends on your business. So it is a very personal thing. There is no best answer. Second piece of advice, protect your cash. Don't use any more of your cash than you absolutely have to. It's hard to accumulate it and it's hard to replace it once you've used it. And if you don't have cash, if you don't have that liquidity, nobody's going to lend you money. Accurately project your liquidity needs. The SBA will tell you that 50% of small businesses fail within 5 years. That's a consistent statistic. Year after year, you see it. And they will go on to say that the main reason for those failures, some 80% of those high failures, happen because it's what they call poor capitalization. They didn't have enough money to get them through to profitability. That's one of the functions of liquidity. Borrow the right amount. Again, poor capitalization, according to the SBA, is the reason that people fail. So don't economize on your loan and say, well, I don't want to take on that much debt, so I'm going to take $50,000 less or $10,000 or $5,000 less than I think I really need. That's a bad idea because if you really didn't need it and now you're short and you can't cover your expenses, your business is going to fail. So don't take too little. Now here's where I contradict myself, but don't take too much because you're going to have to pay that back. You're going to pay interest on it. So even if you don't need all the money you take out, you're still going to pay debt service on that money. So take the time to really do detailed financial projections and get the Goldilocks now. Not too hot, not too cold, just right. Particularly if you're going to go to a bank or to one of the institutional lenders that someone mentioned a second ago, shop around. Don't just go to the bank that you've been working with for years and find out they're an SBA lender and you take long from that. Certain banks have a different appetite for different kinds of businesses. Certain banks will have higher closing fees than other banks. Some are looking to do SBA business startup loans and their interest rates reflect that. And some are doing it, but begrudgingly, and their interest rates are reflecting that. So as you start looking for funding, don't just go to the first bank. Don't just go to the first lender. Look around. I gave you a whole bunch of options today. It may be that the right one for you is the one that you have researched enough and compared to other options. So shop it. Talk to experts. Experts can certainly be your free experts, can be your SBDC counselor, your score mentor, but you certainly want to work with trusted lenders. Again, that goes back to you don't want to be dealing with a loan shark. Really, personally, I like the idea of working with a local bank because I can build a banking relationship. I'm going to have all my accounts with them. I'm going to have my credit cards through them. I'm going to have my line of credit through them. I'm going to have my checking through them. I'm going to have my savings through them. And now I've got a relationship. And when I want to expand and when I want to do more business and I need another loan, that local lender is going to be there for me. You also want to talk to an accountant or certified financial advisor about your funding options. So talk to experts. Nobody knows everything. And as I said at the very outset, I help my clients find loans. I know what the details are, but I will tell you, I also tell my clients to talk to an accountant, to talk to a financial advisor, because I'm not one. You want to make sure you're getting all the expert advice you can. So with that, I will leave you with my contact information. I am a franchise consultant. I promise you that I do this for the SBDC because I believe in small business ownership. If I can help you and you have no interest in a franchise, that's perfectly fine with me. I won't try to sell you a franchise.